Thought Leadership from PwC's National Office.
Hello, I'm Heather Horn, PwC's U.S. Sustainability Technical Leader, and I'm happy to welcome you back to PwC's Accounting Podcast. In today's episode of Sustainability Now, we're diving into the latest updates from the International Sustainability Standards Board, better known as the ISSB, focusing on the proposed amendments to IFRS S2, climate-related disclosures. For this episode, I'm happy to welcome back to the podcast Marcin Lewinsky, who, as regular listeners know, is the chair of our global GHG working group and who's also part of the team working on a response letter to the proposed amendments. So Marcin, welcome.
Well, thanks for having me.
You're welcome. So we're happy to be joining you once again today by video. So if you're listening to this and you'd like to watch along, please check out the show notes for a link to the video. So with that, let's get started. Before we get into the details on the proposed amendments to IFRS S2, do you want to just rewind and at a very high level talk about what IFRS S2 addresses and sort of the point of these proposed amendments?
Yeah, so basically the IFRS standards is part of especially S2 is part of a first set of ISSB global sustainability disclosure standards. It focuses on climate-related risks and opportunities, requires disclosure of certain metrics like GHG emissions, and includes specific requirements to disclose information about scenario analysis and transition planning of reporting entities. It's designed for investors to help them assess the climate-related risks and opportunities. And as I mentioned, it's one of the first kind of globally aligned standards like this.
Yeah, and I think what's interesting here is that the ISSB set up this group, the TIG, the Transition Implementation Group, and actually PwC as a partner who is a member of this group. And the purpose of the TIG was to gather feedback from companies and preparers as they were implementing to discuss those questions that they received and then to make recommendations to the ISSB. And so I feel like we're seeing sort of the fulfillment of a process that started over a year ago with some questions that were given to the TIG, and then now we've seen these actually come out as an amendment. So it's kind of interesting backdrop to what is going on now.
Yeah, and as you said, like as it is typical to financial reporting or accounting standards, after the issuance, there's a lot of analysis, reporting entities and practitioners were analyzing the standards, trying to identify potential issues, inconsistencies, and figure out the best way to apply. It's one of the first of a kind, I would say. So as you can imagine, there's a lot of questions. And I think TIG played a pivotal role in gathering the feedback and pointing out some of the inconsistencies or challenges with implications. So as any good standard setter, you want to make sure that these kind of challenges are vetted through early. So the first set of reporting entities can consistently report the information as required by the standard. Right?
Yeah, and I also think maybe the other point here that's of interest is that we did see some early adoption this year, or some adoption this year. So we know companies in Turkey, Brazil, Nigeria. So we've actually had an opportunity even to talk to some of our colleagues who are involved in the audits of some of those early reports, but we still don't have widespread adoption. And so this is a good opportunity to maybe make some changes and to put in place some clarifications before we do see broader adoption with Australia and other countries, over the upcoming year.
Yes, I would agree.
All right. So Marcin, with that backdrop, let's jump into it. What's the first proposal?
Well, so before we go to proposal, just to clarify, the exposure draft and the proposed amendments are responding to the feedback that primarily TIG received during the last year and a half. So that's kind of just to set up the stage why they're doing this, because they received certain feedback and they're responding to it. So there are a few elements of proposed amendment. Let's start with Scope 3, Category 15. Which is, let's remind our listeners, category 15 is reporting emissions from investments. So it's quite big category, right? And the potential boundary as to what needs to be included in measurement and reporting of these categories, it's a challenging, and there's lots of questions around that. So the first amendment relates to perceived inconsistency. So when you look at a standard doesn't have too much guidance as to what should be included, what type of activities and what asset classes. It refers to the definition included in Scope 3 standard, but beyond that, just basically requires analysis of value chain and proper inclusion of all the related emissions from value chain from its investments. At the same time, basis for conclusions includes extensive discussions of the board members as to what they plan, what type of activities they specifically thought of excluding, and specifically citing the issues with lack of measurement guidance or existing practice. And what they particularly talked about is excluding emissions associated with derivatives activities and some facilitated emissions and insurance. So TIG members and a lot of practitioners pointed out that currently the actual standard does not include any reliefs related to exclusion of this type of activities. Therefore, ISSB decided to make a clarification to update the standard accordingly.
Yeah, and I think this one was interesting, Marcin, because this was definitely a lot of debate within PwC as well, as I think there were sort of two different ways you could read what is in IFRS S2, because it does require, disclosures in your categories or in accordance with the GHG protocol. And it also gives these extra category or these extra disclosures for certain classes of assets, but then it doesn't say only these classes of assets. And to your point, in the basis for conclusions, it was clear they intended it to be only those classes, but I think that's where the debate came from, and then that's what this proposed amendment is trying to address.
Yes, so and what the board proposes is first to clarify that category 15 should focus primarily on finance emissions, which are loans and investments. So when you look at the updates to the standard, now board proposes to clarify or improve the definition of loans and investments to specifically include loans, project finance, bonds, equity investments, and undrawn loan commitments. It also clarifies that an entity that participate in asset management activities should also include emissions from those type of assets, even if they don't, own those assets. Even if, asset management entities primarily manage this on behalf of the clients, but board specified that these activities are included in the definition of facilitated emissions. So that's the first change. Second, clarifying the definition of facilitated emissions. It also clarified that it specifically includes derivatives, facilitated emissions, and insurance-related emissions. So bringing this discussion from basis for conclusions explicitly into the standard.
All right, and then in the proposed amendment, and I think it's important for us to keep reiterating, these amendments are only proposed. This is not final, and the ISSB is in a comment period right now, and then once the comment period closes at the end of the month, I believe, then they'll have to go through the deliberation process, and then before we see the final standard. So again, for our listeners' benefit, none of this is final, but presuming it moves forward as proposed, what additional disclosures would be required?
Recognizing that these what's called them excluded activities could be material, especially for some financial institutions. Board proposed 2 additional disclosures related to quantification and explanation, the extent of excluded activities, activities excluded from category 15. So first, the amendment proposes to disclose the amount of derivative excluded and provide an explanation as to what is considered to be derivative. And second, disclose the amount of other financial activities excluded, right? It's very interesting the way they approach this. The first, they explicitly intended not to determine or define what derivative is. They left it for reporting entities to define what they consider to be derivative activities and describe that and disclose it in a statement, which is kind of a unique. Our initial thoughts were they're going to point to financial reporting definition of derivative to bring certain level of compatibility with what's reported already in financial statements. But the board took different decision, concluded there might be different approach and different companies could consider and analyze this risks associated with derivatives using the different definitions. And second, they also didn't clarify what they think as an amount of derivatives. As you can see, it could be what is the valued and fair valued and measured in financial statements, could be notional amounts, could be notional volumes. So there could be different kind of a definition of what amount is, and board explicitly do not specify that, which to me is a little bit problematic because implements a lot of kind of uncertainty and potential diversity in practice. They also didn't specify what other financial activities are. When we analyze this these proposed amendments, those were the main kind of challenges we had with that. Having this specific quantitative disclosures without providing specific definitions will potentially, introduce certain level of diversity in practice, I think.
Yeah, and I think this one was interesting, and it is an area PwC, I believe, is planning to comment on, because in particular with the definition of a derivative, I think, one of the things that's baseline in the ISSB standards is the connectivity with the financial statements.
Yes.
So it seemed a bit unusual to us that they went in a direction of not tying this to the financials. I know there's some within PwC who thought, well, maybe that's because often with derivatives that would carry emissions, financed emissions with them, you have commodities and otherwise that may qualify for the own use exception or normal purchase, normal sales to those in the US. In any event, I think notwithstanding some of that, looking at whether or not the contracts meet the definition of a derivative would seem to provide that alignment. So it'll be interesting to see what other feedback they receive. And then to your point, not having any definitions around how you're supposed to be prepare these disclosures. I think on the one hand, they're trying to make it easier for preparers. But on the other hand, that's really going to reduce comparability. So again, it'll be interesting to see the feedback and where they land in the final standards.
Yeah, and I think you kind of captured this really well. I mean, in general, having such a potential diversity, do we think that kind of a quantitative information would be really useful for the reader? I think, in our opinion, pointing some qualitative additional disclosures about the nature of these activities would be more useful and understandable for the users of sustainability statements. But I'm also curious what other companies or other kind of entities that are providing the comments, which direction they're going to take. Obviously, we take the view from accountants kind of a perspective, but other market participants might take different views. So we'll see.
Fair point. All right, so Martin, the next potential amendment is in the area of industry classification. So can you remind us the current requirements and then what's being proposed?
As it currently stands, S2 requires entities that are engaging in commercial banking and insurance activities to provide additional disclosures about the Scope 3 Category 15 emissions. It primarily relates to the disaggregation by different types of industries. And as it currently stands, the standard points to Global Industry Classification Standards, or GICS, for determination of these industry classifications. A lot of readers and users of IFRS S2 standard pointed that these kind of GICS standards are not very commonly used. They might be commonly used in Europe, but like in other parts of the globe, those standards might not be used very often. So the users pointed to challenges associated with implementation of these classification standards and also costs involved. That was the primary feedback that ISSB received. And they heard that feedback and they recognized the potential challenges and decided to provide certain level, I don't want to say reliefs, but more options how to classify Scope 3 Category 15 emissions. So specifically, they provide the flexibility and they give companies 3 additional options. So first of all, if any part of an organization uses GICS standards, they still will be required to apply those classification standards for entire organizations, which I'm going to come back to. If the reporting entity is not using these, they are allowed to use any other sustainability classification standards. If there is no sustainability classification standards, but there is some, financial reporting classification standards, company can use it. And if none of that, they should design their own classification standards and disclose it accordingly. So first point, there's a new flexibility. Second point, especially that requirement to use GICS if only part of organization uses them, I think it's overly punitive. It doesn't resolve the challenges and raised and questions raised by to take, right? Because still, let's play the scenario. We have a global entity that has operations in European Union, and only, let's say, 20% of these operations require use of GICS. It means that 80% of organizations still has to implement implement those this classification standard, which might be costly and really time consuming. So although it goes in right directions, I don't think they're fully resolving those challenges that were brought up to them through TIG.
Yeah, so then Marcin, what would we propose instead? Because I don't think we would necessarily be fully supportive of what's being proposed here.
Yeah, so we think the system that allows companies use their own classification that follows how they analyze the risk and how they classify the investments for their own management purposes would be more kind of a user-friendly, I would say, and also truly represent how management sees their own operations, right? So using that would align their own risk assessment, would align potential target setting. Because when you think about this, if a company uses a different classification system, most probably they use it also for setting the emission reduction targets and analyzing the risks and performing scenario analysis or analyzing transition risks. So I think that would be more aligned with how companies are looking at risks and their own operations more holistically. So I think that would be our preference, to allow that type of flexibility and align it with how management is already doing this.
All right, so more to come on that one. Okay, two more. So one of them relates to the GHG measurement methods, and specifically this relates to the fact that in accordance with IFRS S2, an entity is required to pick one of the organizational boundary approaches that's in the GHG protocol, but also permitted to use another method if required by jurisdiction or exchange. But there's been so many questions to the TIG about the interaction, what if it's part of the business or otherwise. So what do we see being proposed here?
Yeah, so again, the main challenge of questions that TIG received related to how to interpret this what I would call relief, right? So the relief specifically says if company is required to use different measurement methodology by some jurisdictional authority, they can use it in lieu of using the GHG protocol as a measurement methodology. But it didn't clarify what if only part of an organization is required by some jurisdictional authority to use this different methodology. Consequently, the amendment clarifies two things. First, that relief is available when jurisdictional requirement applies to an entity in whole or in part, and it would only apply to the part of the entity subject to such a jurisdictional requirement. So I think it clarifies most of the questions that were submitted to TIG. Obviously, the one thing is we have now clarity. The other, it implements certain level of this dual method reporting across the same reporting entity, which might be a little bit challenging for all those people who are used to financial reporting, when generally you apply the same accounting method principles and measurement methodologies across entire organization. In this scenario, companies would be allowed to use one or two or more different measurement methodologies within the same reporting group, which potentially could be challenging, right?
Yeah, I mean, I think I understand why they gave this relief, but I do think this is going to create challenges because comparability and otherwise. So obviously disclosure will be important, but we've focused a lot when we're talking about the proposed changes to IFRS. Interoperability is quite important. And obviously this is sort of a point of divergence that is being adopted. So anyway, I mean, that's already there, and it's just clarifying the relief that's already there, but it will be interesting over time to see how this evolves.
And I think you highlighted one thing that I kind of omitted from my this discussion: disclosure. I think having that relief would be really critical, that the companies provide very clear and transparent disclosure so the users can understand which part of organization, in which part of organization we applying the different measurement methodologies, and what is the potential impact of those, different measurement methodologies. So I would agree with you. Again, we're accountants, so we're used to this, consistency of principles and methodologies across the same reporting group. But again, I don't think there's a challenges in terms of, or there's a, the relief is already there.
Yes,
The only
so this
thing
is
we'll
just
do is just
interpreting.
clarify. Yes.
Yeah, and I guess then that leads to our next one, which is also related to some relief that
Mhm.
already exists, and this is related to global warming potentials. So can you remind us what is the global warming potential, and then what is current relief and what's proposed?
That's my least favorite part of any interview I do with you, when I have to explain global warming potential. Basically, global warming potential allows reporting entities to convert greenhouse gases like methane or HFC of N2Os to the common measurement units of CO2e. Again, global warming potential of different gases, it differs from one gas to another, and having this conversion unit is very useful to have a common measurement unit across different 7 gases, right?
Yeah, and maybe I can just add in here, I think this is because the gases persist for a different amount of time in the atmosphere. And then as well, they have, the other ones have a greater impact if you start to look at these tables. So CO2 is this global warming potential, and then it kind of goes up from there.
Exactly.
But I think that leads into then that IFRS S2 requires companies to use the 100-year time horizon global warming potential. So the most recent IPCC report, that's Intergovernmental Panel on Climate Change under the UN, but they already have some relief, and they're in IFRS S2, and they're proposing to extend that. So what's the existing relief, and then what's being extended?
So in general, basically, when you look at this, it's a link to the jurisdictional relief, right? So basically, right now, as we say that every reporting entity is allowed to use jurisdictional relief, and ISSB recognized the fact that some jurisdictional authorities might require different GWP's values for the measurement. So as an example, one authority can use the latest IPCC values, the other can use it from 3 years ago. Clarification of that relief, clarification of provided in this proposed amendments is aligning the jurisdictional relief with this. So the amendment clarifies that the companies are allowed to use other than latest 100 years GWP from IPCC if they are required to do so by a jurisdictional authority. So to me, it's kind of a clarification, and it kind of is in line with this jurisdictional relief. But I mean,
it's also a point of divergence, though.
Yes.
I think that's where I personally struggle with this, is that, again, I understand definitely the challenges, and I know that there's some people even in our PwC network that see that this is very important for certain jurisdictions. But again, as we sort of look to the future, hopefully over time, these types of reliefs will no longer be necessary as people get more used to measurement and otherwise, but more to come. Okay, so Martin, we gave a summary of the proposed amendments and a bit of picture on PwC's points of view and maybe a bit on our points of view, which do not necessarily always align with PwC's points of view, to be fair. But if we just take a step back, then what's the timeline and what do we expect to happen next?
I think the comments or the comment period is open until June 27 of this year. So anyone, companies, investors, regulators, or company like ours can submit the feedback through IFRS website. Then ISSB will review and potentially finalize the amendments later this year. Their goal is to issue the amendment as soon as possible, considering that we already have some jurisdictions that require reporting under IFRS S2. We obviously encourage everybody to provide feedback. We also encourage everybody to look at our feedback once it's finalized, just to clarify that some of the comments we discussed today might be just mine and yours.
Yes.
And we're still finalizing ours. So I think that's that's kind of what's in near future as it relates to this exporter draft.
Yeah, and I definitely think, again, these are areas where there can be a lots of different points of view, but then ultimately, as we see the final guidance from the ISSB, then bringing this together and following that guidance and understanding the guidance as it's issued will be very important. And so obviously we will continue to keep our listeners up to date as the feedback comes in and then as the amendments progress. So more to come from our point of view.
I would agree.
All right. So then, Marcia, I'm glad you agree on that. What do you suggest to companies in the meantime as we're waiting for this to kind of make its progression?
As with any other changes, our suggestion is to be fully aware of what proposed changes are and start considering what potential impact would it have on scope on the emissions reporting of each company, because that impact of these amendments may vary depending on nature of operations, locations of the operation. So my suggestion is to kind of start considering, would there be any big impact on our scope 3 inventories that we reported in the past or we're planning to report in accordance with S2. So because it might have quite significant impact on different type of organizations.
All right. Well, Martin, as always, such a pleasure to talk to you. Thanks so much for joining me today.
Thank you very much.
All right. And then to our listeners/viewers, thank you as well for joining us today. And if you are interested in more on these proposed amendments to IFRS S2, please continue to watch because, as I mentioned, we will issue additional episodes as things develop. In addition, one of the other topics we've been talking about are the developments of the GHG protocol and the standard setting that they have ongoing. And I've had Martin on previously to talk about that. And we will also be recording and releasing some additional episodes on those developments. So more to come from standard setting point of view, also ISRS. If you were watching last week, you would have seen the episode that I recorded with Diana Stoltzfus. So stay tuned for the latest from us. And I encourage you to subscribe to our newsletter or to check us out at viewpoint.pwc.com.